There are going to be some major changes in credit scores and credit reporting for the year of 2025. This is going to affect everyone. On today's video, we're going to cover 3 major topics that are going to affect millions of Americans with credit reports and credit scores that you do not want to miss. But before we get into this video, I want to make sure that you smash that like and subscribe button so this video gets out to more people so everyone can be aware of these major changes that are coming. So we are going to start at number 3, and you don't want to miss number 1 because that's a huge one for Americans out there, and I also have a bonus. Jumping into number 3 is major changes to credit scores for mortgages. Now, this is going to shift and move into other areas, so it doesn't just matter that it's just for mortgages, but right now, currently, the administration is allowing mortgage lenders to not only use FICO scores, but Vantage scores also. Now, a lot of people will say, well, why does this actually matter that they're gonna use Vantage scores or FICO scores when everyone will get approved? That's where you don't understand that people that actually use Vantage scores will get more approvals. And people say, well, that's great, we want more approvals. No, you don't. Because what's gonna happen is the banks and lenders are gonna be at a higher risk, meaning when people start to default, that will raise interest rates even more, even for people that have good credit scores. So what the administration did is they put a lot of pressure onto FICO. Let's put the actual article up on the screen so you can see. Now, FICO pushed back, and FICO shakes up credit score market. New pricing model for mortgage lenders comes as Trump's administration pushes for regulatory changes to lower costs. Now, you think to yourself, well, yeah, this is great. They're gonna lower the cost of our credit reports for us. No. They're lowering the price for mortgage lenders to get their actual reports a lot cheaper. Yes, the mortgage lenders, not the consumers. And to be honest with you, who's paying for credit reports when they go apply for a mortgage? I didn't when I bought my home. So who is this benefiting? This is benefiting the massive conglomerate companies that are already making thousands of dollars off of every loan that gets approved. So when a mortgage lender pulls your credit reports, they need to pull what's called a tri-merge, and they have to buy that credit report from Experian, Equifax, and TransUnion. Now, FICO is allowing the actual lenders to go directly to FICO, cutting out the credit bureaus. So now what that does, that puts more pressure onto Vantage scores, which are only used for mortgage lending because FICO scores are used for more than 90% of lending decisions in the United States. Now, Vantage is going to be forced to also lower their costs, which again is not going to translate to consumers. It's just going to translate to the actual lenders themselves. So now all of this is from a direct result of the Trump administration trying to push more home sales. But at the end of the day, homes are still at high prices that Americans cannot afford. So lowering the price for credit reports is not going to change the cost of a home in America, which the average cost in America right now is $420,000 to own a home in America, which is astronomical and unaffordable for everyday hardworking Americans. But here's the interesting part that we're seeing. We're also seeing a push from FICO to try to push lenders to use more data-driven habits of you, the consumer. So what they're trying to push is FICO 10T. Now, they have been trying to push FICO 10T for the last 4 years, and lenders just are not budging. They're like, listen, that scoring model is not helping us as lenders. It is going to help us predict the risk of a consumer at a higher rate, but it's not going to get us more approvals. So a lot of these lenders are just not going to adapt to FICO 10T just yet. So just understand, now the T stands for trending data. So the longer you actually carry balances, the longer you didn't carry balances, what is the trending information on your credit report is what they're trying to push other lenders to start using. But again, it's still not being adapted because at the end of the day, banks and lenders need to get approvals to stay in business. Now, moving on to number 2 is a huge one. Buy now, pay later apps are supposed to be reporting on your credit reports, and currently we are only seeing Affirm is reporting. Now, if you have any type of buy now, pay later, I want you to let me know in the comments, is it actually reporting on your credit report? Because we're seeing so many discrepancies across every single platform about this current situation. Because everywhere you go shopping, you now see that they say, oh, you can actually make payments in installments because they're trying to drive more sales into the economy when people still can't afford it. Now, I'm referring to apps like Affirm, Afterpay, Sezzle, Zip, PayPal, which has Pay in 4. There's so many different variants of this, but currently right now, Affirm is the only one that we're seeing on credit reports. Now, we previously reported that they were going to start reporting on credit reports, but then all of these different types of buy now, pay later apps pumps the brakes. Let's put the article up on the the screen here so you can see it. Your buy now, pay later purchases likely won't affect your credit scores for now because officials both with Klarna and Afterpay are pumping the brakes over uncertainty about whether it will help or hurt consumer scores, even if they're making on-time payments. Here's the part that nobody talks about, how these are very predatory, and on top of that, they actually do hurt your credit score unless you have a very thin credit profile. So if you only have one, maybe two things on your credit profile, and then you add some type of buy now, pay later, it might potentially help your credit score. But here's the problem that consumers don't understand. Your credit score is based on 5 factors of credit. One of those is age of credit. Every time you add a new line of credit to your credit profile, you're reducing your average age of credit. So if you're one of those people that's laser focused and you want to get into the 800 club, you need your average age of credit to get over 5 years. Listen to that, what I just said. Let's repeat that again so everyone understands. You need your credit profile to be above 5 years of age of credit for you to bust into the 800 club. Now, understanding that adding credit to your credit profile will help in certain ways. Now, what do I mean by that? Like someone that has a crazy heavy credit profile with a lot of accounts can still get into the 800 club, but it's gonna take a lot more work because remember, every time you add a new line of credit to your credit profile, no matter what it is, it's reducing your average age of credit. So there are people that have 4, 5, 6, even possibly 12 of these buy now, pay later loans on their credit reports, and that is negatively impacting their credit profile and their credit score. And that's exactly why Klarna and Afterpay said, no, listen, we don't want to put it on credit reports because it's going to hurt consumers. And consumers will catch on to it, and guess what? Consumers won't want to do buy now, pay laters anymore. And that would actually drive down the sales for Klarna, Afterpay, and all these pay over time apps that are helping people get themselves in even deeper debt. Let's go ahead and just rip the band-aid off and just say very clearly, if you don't have the money to buy it right now and pay it off from your bank account, you have zero business getting any type of buy now, pay later or anything on credit, because that's exactly why you are in debt. These are predatory lending situations. They were created to keep you in the hole and keep you paying and keep you in debt so you can continue to pay into the system and not take advantage of all of the actual benefits of having a good credit score. Because again, let's repeat it. The more buy now, pay later loans you have, the lower your credit score will get. Now, there's gonna be people that are gonna argue, oh, but it's helping my credit score. Well, as I said earlier, if your credit profile has nothing on it, of course it's gonna help you. But understand, you're going to close that account. And the moment you close it within that 6-month or 12-month period, it's going to tank your credit score. Remember, I told you here first and I warned you first, because what's gonna happen is people will start to pay them off like, I'm out of debt, but why did my credit score drop? Because an installment loan is completely different than a revolving account. A revolving account is very helpful to your credit profile, which is a credit card. Anything that has an installment loan that's open for 6 months, 12 months, remember, it has to close eventually. And the faster it closes, the more negative impact it's going to have on your credit profile. So yeah, you can pay it off in 90 days, in 6 months, or 12 months, but when it closes, your credit score is going to tank and the age of credit is going to disappear, putting you back into the section that you were at in previously. This is why credit cards are very, very important. All you have to do is put your Netflix on it and pay it off every month and you're done. You don't have to spend crazy amounts of money to have a high credit score. I have helped millions of Americans use this same tactic to build their credit profiles. I've taught low-income people, okay, listen, once a month, I just need you to walk into your actual workplace, go into the break room, use your credit card to buy a bag of chips. Boop, that's like $1.50. Then your credit card pays off the full statement amount every month, so you never carry a balance, and you're building credit just by buying a bag of chips or a soda at work once a month. It's really just truly that simple. You don't have to use the full amount that they're giving you. It's not necessary. So anybody that's telling you that is absolutely lying to you. I'm sorry, I went on a little tangent there, but I really want you to be more educated on this topic so you can really make better decisions moving forward with your credit. I want to give a special shout out to all my beasters out there that are working hard to fix their credit using DisputeBeast, the most advanced AI credit repair software ever created that comes with the 110% money back guarantee. But specifically to Brandon, Brandon's credit score went up 185 points after just one round with DisputeBeast. And Ashley's credit score went up 218 points after just 2 rounds with DisputeBeast. But let's not forget about Julio. Julio's credit score went up 266 points after just 1 round with DisputeBeast. DisputeBeast's link is going to be pinned at the very top of the comments and in the video description for anyone that needs to fix their credit. Now, moving on to our bonus is going to be AI is going to be inspecting your credit profiles and credit scores and your banking statements to see if you are worthy of lending in 2025 and in the future. This has already started, ladies and gentlemen. It is no longer just about a credit score. Now, AI is going to be looking at every aspect of your life to see if you are a high-risk borrower and your chances of defaulting. They want to know, will this person stop paying the bank? Let's put this article up on the screen so everyone can see. Move the loan approval process 30% faster with AI. One, they want to speed up the entire process and they want to mitigate risk. Because remember, your credit score is all about risk. Now they can use AI to have more predictive information to want to know if you will default or you won't default. So let's take a look at what it says right here in this highlighted part. AI helps lenders process more loans in less time. Now let's scroll down a little bit till you see AI helps lenders process more loans in less time. Overall, credit analysis were roughly 30% faster at decisioning a loan. To achieve this speed, an AI agent takes over the document collection, assessment of collateral, authentication of documents, and credit worthiness of the customer. So as you can see, we are already seeing major banks have already shifted to this. Now, what banks am I referring to? Big banks like JP Morgan, Bank of America, Wells Fargo, and even massive credit unions like Navy Federal have already shifted their resources to using AI for approvals. So buckle up, ladies and gentlemen. You better make sure that your credit profiles are in line and your bank accounts also. Because remember, if you're trying to get lending directly from the actual lender that you're banking with, they're going to use your banking data against you also. All of your spending habits, how much money is coming in, how much is going out, they can see all of it when you use the same exact lender that you're using to get that approval for a car loan, a mortgage, or a credit card with the same bank that you're banking with. Remember that and keep that in mind when you're going to apply for something. And as time goes on, we will see more lenders adapt and use more AI. It's just inevitable at this point. Last part's the most important. Now moving on to number one, the biggest one of all, medical debt. Now let's put it up on the screen right here. In January of 2025, the CFPB finalized a rule to remove medical bills from credit reports, and that came tumbling down. The Trump administration, along with other entities that were going to lose billions of dollars, filed a lawsuit and beat the case, and the CFPB stood behind them to make sure that medical debt could not be removed from credit reports. Now, everyone's gonna say, oh, well, we already knew this. Yes, I know you already knew this, but there's been a major change that a lot of people are not paying attention to. Let's put the article up on the screen right here so everyone can see it. The Trump administration seeks to return medical debt to credit reports. You heard that right. Seeks to return it to credit reports. So if it was removed previously, we have a problem. They want to put it back on your credit reports. Let's not leave out the bottom part. A federal rule restricting the debt's inclusion has been canceled. Now, the Consumer Bureau is trying to overturn state restrictions. Now, this is a huge deal because a lot of people will say, well, thank God I live in a state that's actually protecting me. This is where it all took a turn for the worse. Now, there are 14 states that actually protect consumers. So what that means is the state is stepping in to say, no, you can't actually report that on the credit reports of the residents of our states. Now, what are those states? So the states that we could find, if I'm wrong and I'm missing your state, please let me know. Washington State, Oregon, California, Colorado, Minnesota, Illinois, Virginia, Maryland, Delaware, New Jersey, New York, Connecticut, Vermont, and Maine. All of those states were prohibiting medical debt from being on your credit reports if you were a resident there. Now, the Trump administration is stopping that. They said, guess what? Federal law supersedes state law and they want it back on your credit reports. And I know, people are gonna say, that's not true. The Trump administration would never do that to Americans. Let's go ahead and put that up on the screen so you can see. It came from the Consumer Finance Protection Bureau. You know, the same bureau that was actually created to help consumers, now they're actually using it against Americans. On Tuesday, October 28th, the Consumer Finance Protection Bureau published published guidance saying Biden-era guidance was wrong in concluding that states can regulate the use of information like medical debt in credit reports. They published an entire guidance basically telling everybody, if you don't like it, you can sue us. And we are going to see massive lawsuits coming out of states to try to protect consumers, because at the end of the day, this is just bullshit. I mean, why do we want to keep holding Americans down and giving more money to these massive conglomerate corporations that don't need it? They've already got billions. Because here's a crazy stat for you. About 14 million Americans owe more than $1,000 in medical debt just in 2021 alone. Nobody is predicting or intentionally getting sick and then not being able to pay that bill. If medical facilities were actually trying to be more transparent and giving them all the different options that you have to possibly pay that debt off, we wouldn't be in this situation, because there are programs that actually help consumers, but of course, it's based on income. There are resources like $4.org. I'll put the link in the video description, and also some more patient resources, so you have more resources to try to cut down this debt or wipe it away completely, because charity care does exist. But again, it's based on income. But you want to see if $4.org can help you get rid of that medical debt or reduce it as much as possible, because you have 365 days to pay on that debt and pay it off in full before it hits your credit reports. Now, here's the big question that people are also asking. So if I have a medical debt that's less than $500, the credit bureaus previously agreed to remove that from credit reports. Will that come back? We don't know, because that was a courtesy that was done by the credit reporting agencies in the Biden era. They worked with the Biden administration to work to delete these from credit reports. But that's not to say they're not going to come back. And that's not to say that the credit bureau says, you know what, whatever, man, we don't care. We're going to report whatever we want to report, because the Biden administration isn't here anymore. So technically, they are still under the agreement that medical debt that is less than $500 cannot report to your credit reports, and paid collections must also be removed. Now, let's put this actual dispute letter up on the screen. This is a medical debt dispute letter that I've created for anyone that needs it out there, and I'm going to put it in the video description also for anyone that needs it. Now, this is very basic, very simple. We're going to ask for validation of this account, including original creditor documentation, proof of permissible purpose to report this debt, and 3, confirmation this account meets all CFPB medical reporting requirements, including medical debt under $500 cannot be reported, paid medical collections must be removed, and only accurate and legally verified accounts may remain. And at the very bottom, I also put a little thing. Additionally, please ensure no medical procedures, diagnosis, or treatment information is disclosed pursuant to federal privacy laws, including HIPAA. So of course, people are gonna say, oh, you already signed a waiver. It doesn't matter. You want to make sure this is airtight, because remember, if it's not accurate, complete, or fair, it must be deleted from your credit reports. We're gonna use all the leverage we can to get this off your credit report and increase your credit score. Now remember, all of the resources will be in the video description for anybody that needs them, and make sure to like and comment and share this video so it gets out to more people, so everyone can stay informed to these massive changes that are happening to credit reports and credit scores. I will continue to work hard to keep you updated on any changes that are happening as we move forward, because as we know, so many things are changing at such a fast pace. And if you have any collections, charge-offs, or negative items that you need to delete from your credit reports, make sure to watch this video right here, because it's going to show you how AI will do all the work for you, mail your letters, give you your FICO scores, and it comes with the 110% money back guarantee. And if you felt that I brought you some value in this video, make sure that you don't forget and subscribe to increase your credit score.